Stocks have rallied this year like it's 2020 all over again. So what's behind that rally? And which macroeconomic indicators should we be paying attention to? Personally, I think that bank lending is one of the most overlooked but powerful indicators. So in this video, we'll dig into one of those surveys to see what it's showing us right now and what that means for markets. Don't forget, if you do enjoy our content, please do subscribe to our channel. That way you won't miss any new content. So let's look at why banks are panicking and stock markets aren't in a bit more detail. I think the narrative in the stock market in the US can be broken down very cleanly into three different phases. And I've illustrated that here beside me with two funds, QQQ, which tracks the NASDAQ 100 index, and ARK-K, which is the ARK Innovation Fund managed by Cathie Wood. The first phase is the YOLO period. This is after the pandemic sell-off when the Fed stepped in to save the day, and then with interest rates at zero, valuations didn't matter, unprofitable tech companies simply surged upwards. And one of the huge beneficiaries was ARK-K, which you can see was up over 200% at one point. Now the party eventually ended when the largesse from the Fed ended, and we saw inflation surge, and J-Pow, or Jerome Powell's effect on markets, which was to bring down those valuations and to crush those growth stocks, really took effect. Now, one consequence of that was that funds like ARK-K fell below their starting value at the beginning of 2020. And even the more venerable QQQ tracker is still down considerably relative to where it was at the beginning of 2022. Now that we're entering the end stages of the Fed's rate hiking cycle, it's already raised rates by 475 basis points, a very aggressive tightening in monetary policy. The question is, where does the narrative go next? Are we going to get a hard landing in the United States? In other words, a recession? Will we get a soft landing, i.e. no recession? And will the Fed miraculously bring inflation down without triggering a recession? Well, I think the key indicators to watch are the commonly known ones, such as profits. Many people are expecting profits to be weak this year. And if that's the case, then that would tend to drag markets downwards. We've already mentioned inflation. That's also another important indicator. And it's a key one to watch because it tells you what the Fed's going to do. But one of the ones which I don't think many people are talking about, but which has just been published this week, is credit conditions, particularly with the Senior Loan Officers Survey. We're going to be talking about credit conditions, so it's important to understand what we mean by that. A crude way to think of credit conditions is how easy it is for a company to get a loan from a bank. Now, during a period of recession, a bank will get more cautious about lending money to companies. That's because default rates would probably pick up, and it doesn't want to end up with lots of bad loans on its books. So in these conditions, when they're about to hit, in the bank's judgment, it'll tighten up its credit conditions and its lending criteria. You can think of this as kind of like a boat battening the hatches before a storm. And then when the storm has passed, what we'd see is that credit conditions would then be eased. So it becomes easier to get a loan, and this of course increases the amount of business and profits for the bank itself. We can also read through into what this means for the stock market and for the bond market, in particular the corporate bond market. Both of those tend to rally and fall in sync with the credit conditions that we see at any point in time. So when credit conditions tighten, you'd expect to see stock markets fall and also junk bonds fall as well. Whereas when credit conditions ease, we'd expect a rally in both those markets. Wouldn't it be great if there was a credit lending survey which told us whether banks were easing or tightening their credit conditions? Well, there is. And that survey is called the Senior Loan Officers Survey, or SLU for short. Why does the Fed run the survey? Well, it's to tell it whether monetary policy is being effectively transmitted to the real economy. It's all very well raising rates and cutting rates, but if companies can't borrow more easily and less easily, that's kind of a waste of time. So this survey, the SLU survey, lets the Fed monitor that. Who answers the survey? Well, these are the senior loan officers at a panel of 80 US banks. And these cover a lot of the assets of US lenders, about 2/3 of the 17 trillion in assets, in fact. What questions do the senior loan officers have to answer? Well, a key one is shown here beneath me. Over the past 3 months, how have your bank's credit standards for approving applications for CNI loans, that's commercial and industrial loans or credit lines, to different size firms, large, middle market and small firms, changed? Here are the latest answers that were published on February the 6th, and this is based on a survey that was carried out in January of this year. Now, what's really notable is that all of the respondents answered tightened considerably, tightened somewhat, or basically unchanged. None of them responded that they'd eased conditions somewhat or considerably. So clearly we're in a tightening environment right now. It's harder to get a loan from these banks. Now those numbers, the tables, are quite difficult to digest, so the SLU Survey publishes this graph. What this shows is the percentage of banks which are easing or tightening. So if we're above zero, then we've got a net tightening of conditions, and if we're below zero, we've got a net easing of conditions. Notice that recently we've had a very clear tightening, and the latest survey simply extends that trend. If you want to learn more about the marriage of macroeconomics and markets, this is the kind of thing I talk about all the time with indicators like the SLU Survey in my weekly market roundup. It's completely free, and it'll be put into your inbox every Friday as soon as I write it. Now, to learn more about that, just click on the link beside me or in the description beneath me. Now, there's some genuine confusion at the moment as to whether conditions are getting tighter. So this is what Jerome Powell said at the February the 1st FOMC press conference. And this took some people aback because he said financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. So if we do see a huge YOLO rally, then that shows that the monetary policy isn't really working. And if you look at one of the indicators of financial conditions, which is published by one of the Federal Reserve banks, the Chicago Fed, it actually shows that conditions were easing since the third quarter of 2022. Now, this index has 3 subcomponents, which has credit conditions, but also risk. So this would be things like the volatility of stocks, but also leverage. And all 3 of those sub-indices showed easing towards the end of last year and into the beginning of this year. So really it depends on which indicator you look at to say whether conditions are now tightening or easing. The ones which take into account market indicators, because markets have rallied, show that there is actual easing going on. But if we go back to the SLU survey, this is what it looks like in the top panel since it was first starting to be published. And the publication started in 1996. And the way this works is that when it's red, it shows tightening, and when it's blue, it shows easing. And beneath that, I've shown high yield credit spreads in the United States. Now, this is how much compensation you receive for lending money to US companies which have slightly questionable credit quality. These credit spreads blow out when credit conditions are deteriorating and when markets expect a pickup in the default rate. That usually happens during a recession. And then in the bottom panel, I've shown the 12-month return in the S&P 500. So let's go through some credit cycles in the past to see how the tightening of standards affected the credit market, but also the equity market. In 2000, you can see that there was a tightening and we saw credit spreads widen. And that's exactly what you'd expect. And at the same time, equity markets sold off. Then during the global financial crisis, we saw exactly the same pattern. Credit conditions tightened, credit spreads widened, and equity markets sold off. We saw a little tightening in 2016, which had the same effect on the corporate bond market, but also on the equity market. But then things got a little bit different with the pandemic sell-off in 2020. Credit conditions tightened because banks were worried. High-yield bonds sold off sharply, so the credit spreads widened very rapidly. But then the Fed bought ETFs for junk bonds. So we saw those credit spreads tighten very rapidly once that happened. But what happened in the equity market was fairly unprecedented because even during this period of tightening financial conditions, we saw that huge YOLO rally. Normally that rally would only happen once credit conditions eased. And then if we go to the latest survey results, you can see we've got another bout of credit conditions tightening, but what we're actually seeing is credit spreads falling. In other words, you're not being compensated for any kind of recession or a pickup in the default rate. The credit market is essentially saying that everything's going to be okay. So why is it that the banks are panicking and tightening up on their credit conditions? There's clearly a huge disparity between these two indicators in the credit markets. Now, we have seen equity markets sell off this time around, but they haven't sold off as much as you might expect. If we go back to the 2000s, the rate of credit condition tightening was about the same as it is now, but the size of the sell-off was larger. So there is some complacency in the equity market as well. So what's behind this stock market dash to trash? Or a less polite version might be the flight to shite. Well, certainly the fact that the Fed is reaching the end of its tightening cycle probably is going to be behind some of the euphoria. Higher interest rates crushed the growth stock rally, so maybe the logic is that now we're just going to go back to the way things were. And if we turn to the transcript of the February the 1st meeting again, you can see that Jerome Powell loves the word disinflation. He loves it so much, in fact, that he mentioned it 11 times. So what is it? Well, remember that inflation, which you can see beside me here using the Fed's preferred measure, which is personal consumption expenditures inflation, it's a measure of the year-on-year change in prices. Now, disinflation is when that rate of change starts to decrease. It's still positive, prices are still going up, they're just not going up so quickly. And we have to have disinflation before we can get inflation back down to the Fed's 2% target. So really what Jerome Powell's saying is that our medicine is starting to work. And that, understandably, has led to some euphoria in equity markets. But as you can see in this tweet from Ensemble Capital, there is a profitless tech index which is published by Goldman Sachs, which rallied hugely along with ARK during the 2020 rally, and which has sold off brutally since. And their point is that you shouldn't get tricked by the narrative that speculation is back. And profitable tech stocks fell from the penthouse to the sub-basement and have only bounced back to the basement. And that's borne out by the graph that you can see here. There's really not been much of a recovery. So although in percentage terms the rally at the beginning of this year has been huge, with ARK up over 41%, and the Nasdaq up by over 17%, compared to where we started at the beginning of 2022, we're still down a long way. In conclusion then, there's no question that if you look at the SLU survey, credit conditions are tighter, and that in turn suggests that banks are worried about a US recession and more bad loans. So certainly their reading is that this is not going to be a soft landing. In contrast, if you look at the high yield corporate bond market, that's signaling that there's no problem at all. There won't be a recession and it's not going to be a hard landing, and default rates probably won't pick up. Now, both of these can't be right. And my personal belief is that the SLU survey is giving the correct indication, and we should fade this rally into YOLO stocks. So perhaps the Federal Reserve will be able to engineer a soft landing for the first time ever, but I think that's quite unlikely. Personally, I think that we are going to have a bit of a choppy period economically, but also in the risky asset markets. So I think there's too much complacency in the equity market and in the high yield corporate bond market, and I probably fade this rally. Now, don't forget our offer. If you do want to learn more about macroeconomics and indicators like the SLU survey and keep up to date with that, you can always do that by signing up for our weekly market roundup. It's completely free, and there'll be a link beside me and in the description beneath me to show you how to do that. And as always, thank you for listening.